Turn on any financial news channel on the first Friday of the month, and you will see a global countdown. Traders in London, manufacturers in Mumbai, and investors in Tokyo all pause their screens, waiting for one exact moment. The catalyst for all this anxiety is remarkably mundane: a routine government spreadsheet of labor statistics uploaded by an agency in Washington, D.C. Why does a domestic report about American jobs instantly dictate the value of a foreign shopper's currency or the global price of gold? To understand why everyday prices shift around the world, we have to track the exact mathematical chain reaction that starts in the United States and ripples out across the global economy. The United States holds the largest concentration of capital on Earth. Because Wall Street is home to the world's biggest technology firms, banks, and investment funds, the U.S. acts as the central anchor for the entire global financial network. Every month, the government releases data drops measuring new jobs created, the unemployment rate, consumer spending, and how fast prices are rising. These are the stones dropped into the pond. Investors feed these metrics into one primary question: is the American economic engine accelerating or slowing down? If it accelerates, growth pulls international markets upward. If it slows, the U.S. economy acts as a drag, pulling down global growth. International markets track these spreadsheets obsessively because they set the financial speed limit for global trade. Let's look at how the first wave hits. Imagine a company that manufactures mobile phones. The most vital piece of data for them is the U.S. employment report. When a report shows strong job creation, it means millions of citizens have stable incomes. Those citizens buy more phones, which directly drives up the manufacturer's corporate profits. Anticipating those higher profit margins, institutional investors rush to buy shares in the company, driving the broader stock market upward. The reverse is equally true. If job numbers come in weak, it signals an upcoming drop in consumer spending. Investors, seeing the mathematical threat to future profits, will immediately start selling their shares. The stock market is a real-time calculation, constantly adjusting to the raw purchasing power revealed in those government reports. That stock market shift is just the first wave. The second, much larger wave is triggered by the U.S. central bank's reaction to the data, their decision on interest rates. If the reports show inflation running too hot, the central bank raises interest rates to make borrowing expensive and suppress spending. If the economy looks weak, they lower rates to encourage investment. This domestic policy lever immediately crosses borders. Because higher interest rates yield better returns, foreign capital floods into the U.S., driving up the global value of the American dollar. As the U.S. dollar strengthens, it mathematically forces a decline in the value of foreign currencies. A stronger dollar means the Indian rupee, the British pound, or the Japanese yen suddenly buys less. This scale shows the consequence. Global resources are priced in dollars. A stronger dollar reduces purchasing power for commodities like gold and oil. Consequently, countries pay more for imported fuel, even if local demand hasn't changed. An interest rate adjustment made in Washington, D.C. dictates the cost of shipping goods and pumping gas in local neighborhoods thousands of miles away. Right now, international investors are holding their positions, waiting for the next batch of U.S. economic data to confirm whether the current macroeconomic cycle is expanding or contracting. All this pent-up anticipation means that the exact minute the numbers are published, billions of dollars will move in seconds, causing sharp swings in stock prices and currency valuations. While institutional traders have to react aggressively to every monthly decimal point, you do not. Ordinary citizens don't need to panic over a single day's news headline. The global economy naturally breathes in deep, long-term cycles of growth and retraction. It operates on structure, not unpredictable chaos. When you trace the chain reaction, the noise of the 24-hour financial news cycle fades away. You stop seeing random market panic and start seeing the predictable rhythm that connects a simple American spreadsheet to your daily life.